All right, let's dive in. Today, we are putting on our detective hats. You know how you look at a stock and just see a bunch of numbers and charts, but a professional investor seems to see a whole story? Well, it's not magic. They have a method, a kind of investigation. And today, we're going to walk through that exact process, step by step.
So this is the big question, isn't it? How do the pros separate a real gem from all the market noise? I'll tell you, it has nothing to do with a crystal ball or just a gut feeling. It's all about a disciplined process, gathering evidence to build a rock-solid case. Okay, let's open the case file.
Every investigation starts with choosing the right lens to look through. In investing, you've basically got two main schools of thought. On one hand, you have technical analysis. That's all about charts, patterns, trying to predict the market's next move. It's very short-term. But the pros, the real long-term investors, they live and breathe fundamental analysis. This is about one thing, understanding the business. You're not just trading a stock ticker, you're buying a piece of a company. And that's the approach we're going to master today.
So step one of our investigation doesn't start with a calculator. It starts with a story. Before we even think about touching the numbers, we have to understand the subject of our investigation, the company itself. This part is all about gathering those initial qualitative clues that tell us if this business is even worth digging into deeper.
Okay, think of this as our evidence board. Each one of these questions is a crucial piece of the puzzle. First, how does this company actually make money? Is it straightforward? Next, what's its defense against competitors? This is what investors call a moat. Then, who's running the show? Is the management team any good? Are they invested themselves? And what about the neighborhood it operates in? Is the industry growing or shrinking? Answering these builds the whole picture.
And this idea of a moat is so critical. It's a favorite concept of legendary investors like Warren Buffett for a reason. He's talking about that special something that protects a company. It could be a super strong brand, a patent on a unique technology, or just being so big that no one else can compete. A wide moat means the business can protect its profits for years and years. It's probably the single most important clue you'll find in this first phase.
Okay, so once we've got the story down, and it seems compelling, it's time to move from the field to the forensics lab. This is where we get our hands on the hard evidence, the numbers. We need to see if the great story we just heard actually holds up when we look at the company's financials.
Now, let's be honest, financial reports can be super dense and confusing. But really, all those pages of numbers are just trying to answer three pretty simple but really powerful questions. First, is the company profitable? Second, is it financially solid or is it about to crumble under a pile of debt? And third, maybe the most important of all, is it actually generating cold, hard cash? Let's see how the pros figure this out.
So our first piece of forensic evidence is called return on equity, or ROE. The easiest way to think about it is like this. For every single dollar that shareholders like you have put into the company, how many cents of profit does it spit out each year? It's a really clean way to measure just how profitable a business is.
So what's a good number look like? Well, the pros are typically looking for a return on equity that is consistently above 15%. When you see that, it's a huge green flag. It tells you that the company is incredibly good at making money with the capital it has. Next up, we need to run a stress test to check the company's financial foundation. We use something called the net debt to EBITDA ratio. I know it sounds super technical, but the idea is actually pretty simple. It basically asks, if the company used all of its operating profit to pay off its debt, how many years would that take? It's a direct look at the company's financial risk. And for this test, the magic number is 3. A ratio below 3 is generally considered healthy and under control. If it starts creeping up much higher than that, it could be a red flag that the company is taking on way too much risk.
And finally, we get to the ultimate proof of a company's health. Free cash flow. This isn't some fuzzy accounting number. This is the real, actual cash left in the bank after the company has paid all its bills and reinvested whatever it needs to keep things running. This is the good stuff. The money they can use for dividends, for growth, for anything. A business that's swimming in free cash flow is almost always a healthy business.
Okay, let's recap. Our investigation has found a high-quality company, the story makes sense, the financial forensics are solid, we're feeling good. But, and this is a huge but, a fantastic company can be a terrible investment if you overpay for it. So now we have to move into the next critical phase, figuring out what's a fair price to pay.
Now, the tool you hear about most often is the price-to-earnings ratio, or PE. It just tells you how many euros you have to pay for 1 euro of that company's profit. So a PE of 20 means you're paying 20 times what it earned this year. Seems simple, right?
But here's the secret. By itself, that number is almost totally useless. See, a PE of 20 means nothing in a vacuum. To understand it, you absolutely need context. You have to compare it to its closest competitors and to the average for its entire industry. In this example, our company's PE of 20 is a little cheaper than the industry average of 22, but a bit more expensive than competitor A. It's all relative.
To get an even smarter picture, pros will use a sharper tool, the PEG ratio. What this does is it takes that PE ratio we just talked about and it divides it by how fast the company's profits are expected to grow. This helps answer a really important question. Is a high price tag justified by super fast growth? As a rule of thumb, a PEG ratio below 1 can be a big clue that a stock might be a bargain.
All right, we've gathered all the clues about the business story. We've analyzed the financial data in our lab. We've figured out how to assess its price. Now it's time to bring everything together, look at all the evidence on the table, and finally, render a verdict.
When you boil it all down, the entire professional process comes down to these 4 steps. You start by finding a company that looks promising. Then you do your homework, the whole investigation we just walked through. After that, you figure out what you think it's really worth. And then, only if the price is right, you make your decision based on one last, absolutely crucial principle. And that final principle is called the margin of safety. This is the absolute bedrock of smart investing. It just means you only buy a stock when its market price is significantly cheaper than what your investigation tells you it's actually worth. That gap, that discount, is your protection. It's the buffer that saves you if you made a mistake or if things just go wrong. It is your ultimate insurance policy. Now, before you close any case, a good detective always does one last sweep for anything that feels off. For an investor, that means looking for red flags. Are profit margins shrinking quarter after quarter? Is debt suddenly piling up for no good reason? Are key executives jumping ship? These are all warning signs that the great story you uncovered might have a dark side you haven't seen yet.
So if there's one thing to take away from all of this, it's this. All the numbers and ratios we talked about are just tools in the detective's kit. The real skill, the thing that gives you an edge, is using those tools to build a deep, genuine understanding of the business itself. Because at the end of the day, you're not just buying a stock, you're becoming a part owner in a company. So the final question is, which company story is compelling enough for you to investigate next?